Hello, I'm Steven Brice. I'm a partner in the Financial Reporting Advisory team at Mazars. Leasing has always been an important source of finance. Estimates put the global leased assets at £765 billion, which is equivalent to about 21 times the UK's annual defence budget. The current operating lease commitments of the top 50 FTSE 100 companies comes to £94 billion alone. It is important that the accounting rules for leases provide users of financial statements with a complete and comparable picture of an entity's leasing activities. So, why is there a need to change the requirements? Existing accounting rules for leases require lessees to classify leases as either finance or operating leases. However, there are many problems with the current requirements. In particular, it is difficult to define the dividing line between an operating and a finance lease. Having accounting requirements that depends on classification does not meet the needs of users of financial statements. Different models lead to a lack of comparability and to a limited extent some structuring activities. In my view, the main problem with the accounting requirements is that companies do not reflect assets on their balance sheet that are controlled by companies. More importantly, they do not reflect the associated liabilities based upon the definitions in the IASB's framework. Surely, if an entity signs up to an agreement over several years, it would be appropriate to reflect the liability on its financial statements. Under current GAAP rules, the requirements for operating leases are an off-balance sheet commitment. Together with the US standard setter, the FASB, the IASB initiated a joint project to develop a new approach to lease accounting. This would ensure that assets and liabilities arising under operating leases are reflected on balance sheet. A discussion paper was issued back in March 2009. This was followed by a leases exposure draft issued in August 2010. In January 2011, the board started their redeliberations. While the underlying concept of all leases being reflected on balance sheet has remained at the heart of the proposals, the tentative decisions raised during the redeliberations were sufficiently different to warrant re-exposure. A new exposure draft is now expected in the second half of 2012. For lessees, the proposals use a right-of-use model. Under this, an entity would determine whether a contract contains a lease based upon the substance of the contract. The new single accounting approach would require a lessee to, firstly, to recognise a liability for lease payments and a right-of-use asset, both measured at the present value of the lease payments. Secondly, to measure the liability to make lease payments using the effective interest rate method. Thirdly, to amortise the right-of-use asset on a systematic basis. The single model proposed will remove one of the last areas of off-balance sheet accounting. The impact of such requirements could destabilise corporate balance sheets. Companies that have large lease obligations relative to their size will be the most affected. Retail is one of the sectors that's likely to be hit the hardest by the new proposals. 10 of the most well-known supermarket chains, including Tesco's, Sainsbury's and Morrison's, are holding an estimated £45 billion in lease obligations on their balance sheet, according to a study of their published accounts. Certainly, the lease proposals could lead to an increase of many billions for UK PLC. The key area of detail considered by the board include scope of the proposals, short-term leases, assessment and reassessment of lease terms, variable lease payments and cancelable leases. The changes proposed as part of the redeliberations have largely been practical. Prior to the redeliberations, there were concerns that estimating lease terms would be too judgmental. In my view, the new proposals are an improvement on the original exposure draft. However, in practice, the proposals are likely to lead to a reduction in lease term, and this will have a significant impact on the property sector. To conclude, I believe the boards have addressed the key concerns and objectives in the proposals. However, the commercial implications of the leasing proposals are still likely to be very significant. Property strategy is likely to be back in the spotlight, and there'll be more time spent renegotiating leases and finding information required to be disclosed in financial statements. All entities that have leases should be thinking about the implications of these proposals now, so that they are well placed when they become applicable in the future.